The market opened, and for a moment, everything looked normal. Then the numbers for silver started to dance. Not a gentle waltz, but a violent, convulsive thrash. On December 27th, the silver futures price rocketed, more than 6% at the open. Global screens flashed $83 an ounce. Euphoria, then a quick gasp before the plunge. Hours later, the ascent was erased. Price tumbled to around $75 per ounce. Volatility is not unheard of, but the pattern was peculiar. A massive gap up, a brief new high, and a brutal reversal in one session. Like a sprinter exploding off the line only to collapse just shy of the tape. The move left a trail of questions. Was this a rational response to news or something less organic? From hedge funds to small retail accounts, everyone asked the same thing, because the speed felt mechanical, as if a force injected buy pressure and vanished without a trace. This did not happen in a vacuum. Silver climbed from about $29 to $75.85 in a year. It became one of the hottest assets, outpacing gold. The day gapped above the prior close and printed a record $79.25. Intraday, futures pressed toward 83, then a near 10% peak-to-trough collapse within hours. Moves this rapid signal a market dominated by fast money and uncertainty. It was not just silver, platinum and palladium were also on a tear. Fears about inflation and geopolitics fueled a broad flight to hard assets. Silver is both industrial and monetary, two engines for volatility. It attracts safety seekers and aggressive speculators alike. China controls roughly 60 to 70% of output and is imposing export controls on January 1, 2026. Licenses go only to large, state-sanctioned firms producing at scale with big credit lines. Small and mid-sized exporters get cut off, shrinking international supply almost overnight. Rational panic. Secure inventory now, before supply tightens and prices rise further. A supply shock can explain the surge, but not the rapid round trip that followed. The vast majority of trading is no longer done by humans. Across FX, commodities, and equities, algorithms dominate volume. Sophisticated code executes millions of orders in fractions of a second. They are the new apex predators of the financial ecosystem. Bots make markets, detect patterns, and sniff large orders to front-run impacts. Orders race through fiber to servers co-located with exchange engines. In a microsecond arms race, speed is an edge that prints profits. At the open, liquidity is thin. Bots can amplify any burst of buying. Buy signals cascade, pushing price higher at machine speed. Then, strategies flip, unleashing sell torrents to take profits. Spoofing places large fake orders to create a false signal of supply or demand. Others react, assuming a move is coming, and they sell or buy in anticipation. The spoofer cancels, then executes a real trade at a better price. In reverse, fake buy walls lure chasers before a rug pull. Illegal, yet hard to prove when orders live for microseconds and intent is hidden. We have seen this before, the flash crash of May 1, 2011. During quiet hours, with primary markets closed, silver suddenly collapsed. 12 minutes, minus 12%. Thin liquidity in Asia-Pacific hours made the market fragile. Stops triggered more selling, a vicious feedback loop. The speed and intensity fit high-frequency, machine-driven trading. No single culprit named, but a bot-dominated market was exposed. It was a wake-up call for better safeguards like circuit breakers. Compare 2011 and 2025. Patterns look eerily similar. A large player or coordinated group can engineer rapid moves through the plumbing, trigger stops, force liquidations, and profit from manufactured volatility. The technique stays the same, even as tech evolves. Those trusting the screen for fair price discovery bear the cost. Human judgment moves slowly. Code moves at light speed. The core puzzle remains. Who or what really moved silver that day? Recent research shows independent trading bots can learn to collude without explicit instructions. They avoid undercutting, sustaining higher prices at investors' expense. In one model, bots stayed conservative, until a trigger, then switch to extreme aggression. Silver's lurch to 83, then vertical reversal fits the pattern. A cartel with no leader, no meetings, no explicit agreement, only learned profit maximizing behavior, and their game now spans the entire market. First, emotional discipline. Do not chase parabolas or panic in crashes. Stick to a written plan. Second, risk management. Never risk more than you can afford to lose. Use stop losses. They are your personal circuit breaker. Third, know the fundamentals. Track real supply and demand, like China's export controls. Be skeptical of hype. Verify before acting. Finally, think long-term. The machines win microseconds. Humans can win decades. If silver is a hedge within a diversified plan, daily chaos matters less. Be patient, be disciplined, and let the bots fight their battles while you keep your eyes on the horizon.